who are joining us. So thank you, everyone. We just want to take a few seconds to just acknowledge your presence, and thank you for being with us on this Thursday. We don't plan to take too much of your time, and we'll let you get back to your Thursday night, but I'm going to turn the time over to our advisors, John and Jordan, and they're going to be sharing a 2021 investor outlook, and then Jordan is going to be chatting about the Secure Act a little bit further. We just want to note we hope to be able to get back to any in-person events here by the fall. Hopefully it will be safe for us to join together again, and we'll probably still continue to potentially offer these webinars on, an off basis, just because we know it's important to connect with everyone and kind of provide a different medium between webinars and in person. So other than that, John, Jordan, I'm going to let you take it away, and I will hop on after the webinar. I do want to note for anyone that's listening in and participating, there is the Q&A box at the bottom of the screen that if anything at any time pops up and you have a question, please feel free to put your question in that Q&A box. We are going to hold our questions until the very end, but after the presentation is over, we will be addressing those. So if you have anything you'd like to ask, put it there and we'll get it answered for you. So other than that, John, Jordan, it's all up to you. Take it away.
Thank you, Ariel. So again, just first and foremost, thank you guys so much for joining us. Thank you for being here with us. John and I have said it before, we wish we could see you in person and be handling this live, but this is of course, a way that we still are able to connect and share the information that we feel is very important to do so. Just a quick overview for today. John's going to be highlighting some items regarding an update on equity markets, an outlook for investors regarding what 2021 will bring, and then I will be covering some pertinent items with the Secure Act and changes that will really be impactful in 2021. So for that, John, I will let you take it away.
Sure, and then just put things in context. We always share this slide that there's really there's certain key areas of financial planning, preservation planning. We want to make sure what you have worked so hard, you keep it safe. Then we want to put together a retirement planning, whether it's how much do you need if you're building up your savings toward retirement, or if you're in retirement, let's maintain your cash flow, make sure we're not spinning down your assets. It's not always how much you make, it's how much you keep. So we're in the middle of income tax season. So after income tax season, we do an income tax review, which we try to do that with all of our clients. We really like to understand taxes at an intimate level. Estate planning, you work all your life to build up your estate. Let's make sure we transition that wisely to those people that we love and care about. And then investment planning, right? These are the 5 areas that we work on. And, we like to say, prepare financially today, live purposely tomorrow. So with that, let's look at the equity markets thus far. I think we ran this chart through the end of last week. The market was up about 5.59% year to date. Right now, it's actually up about 3%. So it's come down a little bit more. But generally speaking, the market's so far so good. But if we kind of go back into context, I like to go back in context because a year ago at this time, we had that huge drop in March of last year when equities really took that big plummet. And that's the time that Ariel and I was calling all of the clients, talking to them saying, listen, let's just stay the course. It is bad and it's going to be bad for a while. But what we don't want to do is make it worse by selling equities when they're in a down position. Actually, when we were in that big drop early last year, I think we all would have signed up to be negative 10% by the end of the year. The markets actually have recovered really well last year. And so far they're doing reasonably well. Albeit not the best week right now, but the markets have recovered quite nicely since the big drop in first quarter of last year. So I want to talk about GDP and a few other things. GDP is kind of a tale of 2 quarters or two areas. If you look at this, GDP, well, first off, is a gross domestic product. So it's one of the primary economic measures of the economy. If we have a positive GDP, that means our economy is expanding. If we have a negative GDP, then we're in a recession. If the GDP goes negative for 2 quarters, that's the definition of a recession. So you see, it was steady and boring for about 3 years. And you know what? Steady and boring is good, right? GDP was positive, anywhere from like 1 to 2.5%. Then we had that really big drop in first quarter, and really specifically in second quarter of last year. We had that huge drop when everything shut down. And then we had a really nice rebound in third quarter, but we were still negative year to date. Year over year, we're still negative. This year, GDP is it's being projected at about 4.5%. So positive 4.5%. That'll be a very strong year, positive 4.5%. So for 2021, for next year, it'll probably drop down to around mid twos. And then we're probably for 2023, economists are projecting kind of more what we saw back in 2017 and 2018, 2019, about a 1 to 3% GDP. Our GDP for the US, I said, is going to end the year at about 4.5%. Internationally, most projections are at about 5 to 6% internationally. Some of that's because China is going to come in at about 7% this year. So the GDP, the economy, is expected to expand quite nicely for this year. For unemployment, I wanted to go all the way back to 01 because you see the dot-com bubble, unemployment spiked up in 01. And then we had this huge spike in the financial crisis, 07, 09. And then we had this huge spike in first quarter of last year. And that's when everything shut down. So obviously, folks that were in the restaurant business, in the travel business, hotels, were laid off. And so unemployment had a huge spike. I think as basically about as quick as it went up, it has dropped back just as quick, but not all the way down, because until we really, when I was calling people and talking last March, I made all these calls to clients. I remember saying it's really this crisis or this recession is going to be defined from the virus to the vaccine, right? And so right now we're going to talk about this in a few minutes. We're getting to the vaccine, but really that unemployment is not going to drop all the way down until we get through the vaccine distribution. Right now, unemployment is at 6.3%. It's expected to continue to drop to about 4 to 4.5%, probably about 4.5% to 5% by year end. And then it'll take us all the way through probably the first 6 months, 2 quarters or 3 quarters of next year to get a step back down to our normal run rate, which is going to be, I think, 2.5 to 3%. But this is a great story, but we're not all the way home just yet. Until we can go to restaurants and bars at 100% capacity, until we can travel and corporations or sending corporate travelers out doing corporate events, that's when it'll be all the way back. When you don't have to spend $200 to get COVID tested to fly a trip to Hawaii to and from, that's when we'll be back, and we're not going to be there for probably still several more months.
Yeah, and John, I think that ties in nicely too with the last slide that you had regarding GDP. We see that gap. That really represents those industries, right, that have yet to open up. Our hospitality, our restaurants, really fully are not being utilizing that employment. So once that starts opening up, I think that's where we're going to see a lot of that GDP pop come from.
Totally agreed. So, the Fed funds rate, when the crisis hit, when the COVID hit, the Fed took rates back down to zero, basically. So, a year ago, Fed funds rate was at 1.55. CDs and money markets were a little bit higher, not great, obviously, but higher than zero. Now everything's basically dropped. Rates have dropped down. The Fed is going to keep rates low for long. So we're probably going to see 0% all the way through this year into next year. Now, there is some talk about some inflationary pressure coming down the road. And I'm going to talk about some of the reasons for that. So, so it's possible. That would be a first world problem. If we get through this, we have a lot of growth and the Fed decides to move rates back up. That is a first world problem. So, if that happens next year, that'll be welcome. But for right now, rates are low for long to keep the economy moving. So there is a little bit of a disconnect between the economy and the stock market. The stock market, like I showed earlier, after that big drop, the stock market ended positive last year. Who would have thought that March or April or May of last year? And it's even off to, it's been a little rocky the last few days, but so far year to date it's positive. The reason for that is because the stock market is forward looking. So they're pricing in corporate profits are going to really pop this year. They're pricing in unemployment dropping. They're pricing in a GDP of 5.5%, 4.5%, 7% internationally. So there is a little bit of disconnect, but the economy is definitely starting to catch up. So let's talk about a little more in depth why the economy is catching up. There's a lot of data on this slide, but I wanted to make sure we share this picture. So if I start on the left part of this slide, and this slide is up through maybe like about a few weeks ago when we were preparing. So it's not up to date today, but it sends the right picture. So the vaccine rollout, 75 million doses have been distributed and about 63 administered as of February 21st. Pfizer and Moderna, their confirmed supply of doses to the US, 220 million doses, double doses by March 31st, 400 million by May 31st, 600 million by July 31st. Johnson & Johnson's single shot vaccines, 20 million doses by March and 100 million by June 31st. I think Biden said about a month ago that we'd have enough doses for the entire country to have vaccines by the end of, I don't know if it's July or August, but since then he's come in and said by the end of, I think it was it June? I apologize for not knowing the month, but I think it's
June.
A lot. It's June. Yeah, thank you. So definitely this is going to open up the economy tremendously. And then the bottom left, the transmission rate or the R naught rate, anything like back in March and April last year, it was above 1. So what that means is if I got COVID, I would transmit it to, at one point, I think it was up to 1.2, which maybe doesn't sound like a lot. 1.1 or 1.2 is barely over 1. But with a virus and with 330 million Americans, that's a lot. That's when you have increasing cases. That's when hospitals get overloaded, emergency rooms. That's when things get shut down. Once you drop below 1, and right now we're at 0.85, that means if I get COVID, I pass it on to less than one person. Why is that? And that's because right now about 30% of Americans either have the vaccine or have the virus. That number is going to be 40% coming up, I think, in about another month or 45 days. And then it'll be 50% shortly thereafter. So there's this talk about herd immunity. So scientific herd immunity, and again, I'm not a scientist, but scientific herd immunity is when we get to about, the numbers are varied, but between 75 and 90% of people having either the virus or the vaccine. And technically that's not going to happen until maybe November of this year. But 50% of Americans are going to have the virus or the vaccine within the next 60 or 90 days. And that's only people that are confirmed having the virus. If you read some studies, they're saying that there's a huge part of the population that have the virus, had it, and didn't even know they had it. So really, if we can know that 50% have the vaccine or the virus, if you factor in the people that don't even know they had it, that's already up to herd immunity. So what's going to happen is we have scientific herd immunity that's going to technically happen toward the end of the year, but we have this unscientific herd immunity, or what I'm going to call a little bit something different. What's starting to happen is this emotional herd immunity, which is we're trending in the right direction. People are more comfortable going out. By way of an example, my father, who now got his second dosage, he was limiting his travel. He wouldn't go back to Nebraska to see our family and friends, and he wouldn't go out to eat very much. But now he started to plan his trip to Nebraska, and he's starting to go out at lunch more because he's feeling safer. And when that happens, as much as things spiraled out of control, they're going to really start to spiral and be positive in the right direction. Now, I'm not making commentary. I think in some cases, we still have I've got some concerns in that some, like when Texas is opening up, no mask mandates. I don't want to have a political debate, but I want to paint a positive picture, but I also want to say that we could have different spikes. We're not out of this yet. So we still have over 500,000 Americans that passed away. We have some serious cases ahead of us, so we're not out of it, but we're definitely moving in the right direction. A couple more data points. I'm going to move past this, but daily cases in January were 260,000 daily cases in January. Right now, around 91,000 daily cases. That's still not good, but it's a lot better than 260,000. The positivity rate back in January was 13.6. Now it's closer to 5.7. 132,000 hospitalizations versus 67,000. So we are approaching, getting much closer to the end, the light at the end of the tunnel. So that's great news for the economy, but we still have a few challenging spots ahead of us. That is for sure. So let's talk about some other things going on from the economy and from a political standpoint in 2021. So we have the stimulus that's being debated right now in the Senate. We had a $900 billion stimulus toward the end of last year, and we've got a stimulus that's going to be coming out right now. There's a lot of debate on the right now. The Democratic plan is 1.9 trillion. It'll probably come in less than that, 1.2, 1.5 trillion. We could have a debate whether it's actually needed at this point. It probably is needed for sure, but to what level is going to be up for debate. But what is going to happen is there will be some sort of stimulus, that is for sure, whether it's 1.5, 1.7, or 1.2, but that is a lot of money that's going to be hitting the economy. After we get through that, there most likely will be an infrastructure bill. Let's go back one more, Jordan. There was probably be an infrastructure bill in this year as well. And that's going to be pretty large. There's bipartisan agreement that we need an infrastructure bill. So that's going to be a lot of money hitting the economy. These things are going to really boost this GDP number, okay? The other thing that's going to happen is we are going to have tax changes at some point this year. And let's go to the next slide. We'll talk about that, right? So I don't want to go into a lot of detail. Jordan and I talked about some of the proposed tax law changes when we did our last economic update. So until it becomes a little firmer, that's when we'll do another webinar, or we'll communicate with our newsletter. We'll do a webinar, or we'll do an in-person event to talk through these. But we will definitely have some tax changes under the Democrats or under Joe Biden administration. What are they going to be? I'm not sure, but here are some of the ideas that have been floated. One is increasing taxes for those people who make over $400,000, expanding the Social Security tax to earners that make over $400,000. Right now, you get taxed, your Social Security tax, you get taxed up to $142,800 of taxable income. The new proposal would be to stop taxing that, but then if you make over $400,000, start taxing you again. Increase corporate tax rates to 28%. For years and years, the corporate tax rate was at 35% under Republican administrations. It dropped down to 21%. So if they go back up to 28, it would split the difference. Raising capital gains on tax filers with incomes over 1 million to 39.6%. Limiting itemized deductions to a cap of 28%, and then reducing the estate tax exemption. So again, Jordan and I were all like apolitical. We have, we love all of our clients. We have clients that are far right and far left, and we love them all. And frankly, when we have our dinners, we'll put them at the same table. And as long as they don't talk taxes, they love each other. I mean, as long as they don't talk politics, they love each other and have a great time. So we are politically neutral. So I'm not making a comment on any of these things. But what I will say is these changes will they will impact folks, but they're only going to impact people in the really high income tax brackets, generally speaking. And this is going to be a first world problem. So for our clients, they're in high income tax brackets. They're still going to vacation to Cabo. They're still going to take a cruise down the Rhine River in Europe. None of these are going to be so punitive that they're going to change their standard of living, which doesn't mean we're not going to stay on top of it and try to help people make changes to decrease their taxes as much as possible. But it's not going to be too punitive. Again, these are only proposals. We're going to stay on top of this and communicate the impacts immediately when they become more tangible. So the next slide is what I talk about in relation to just trying to bring everybody back to center, right? So again, my view is 85% of the economy, the stock market, is not driven by who's in the White House, who's in either house of Congress. It's driven by hard workers, like people on this call. It's driven by entrepreneurs. It's driven by Jeff Bezos, Warren Buffett, people that get up, teachers, carpenters, architects, people that get up and go to work and get things done every day. But I wanted to, show some tangible data. What this slide shows is performance of the Dow during congressional sessions since World War II, when the Democrats controlled the House, the Senate, and the White House, at all parts of government. So by way of example, let's go back to when President Kennedy was there from 1961 to 62. When he was there and the Democrats had both the House and the Senate, the Dow went up 8%. In 63 to 64, under President Johnson, the Democrats had everything. The Dow went up 33%. If we go to President Carter, bottom left, or second area from the left, 77 to 78, the Dow went down 17%. So generally speaking, the market has gone up even when the Democrats had all sessions. Again, I'm not a Republican, I'm not a Democrat. And you know what? If the Republicans in 4 years have the presidency in both sessions of both House and Senate, we'll show a slide like this. It shows Republicans, and guess what? It'll look almost the exact same. The numbers will be different, The boxing would be a little bit different, but they'll be more green than red, and they'll be more positive than negative because it's not about the politicians. It's about the hardworking Americans. And even though politicians change, hardworking Americans do not change. Okay. So with that, let me see. Let me turn it over. I think Jordan, you're up next. Is that right? Yes.
That's right. All right. I'll take it from here. Thanks, John. So again, we're just going to be covering a couple items. We're not going to take a whole lot of time. And this was something the Secure Act brought into policy back in 2019. Some of you might remember at the end of 2019, John actually had an event live Papados where he covered some of these items, covered the impact. Of course, some of this was took a sidestep with a little thing known as a pandemic last year, and it made some changes to that. But we really want to come and revisit it, and we want to tackle some items that are going to be pertinent for 2021 and things that we really need to be mindful of, especially when it comes to planning and just in general of what's going to impact us with that act. And so I'm just going to cover some brief, hard-hitting pieces of this. There's a lot of legislation that went through, but I just want to cover some core elements of that. So first and foremost, the RMD, so the required minimum distribution age, has increased from 70 and a half to 72. So those born after July 1st of 1949, they now have to take RMDs as of age 72, which means if you're born after July 1st, 1949, this year would be the first year for those who are 72 where you actually need to make a RMD distribution. And I believe the first year of an RMD distribution, you can actually delay until April 1st of the following year. But with that said, the next item that we want to cover is going to be the 10-year rule. 10-year rule is really key, especially when it comes to planning. Anybody who's inheriting IRAs or has an IRA that will be planned to leave as a legacy, there's been a lot of changes with how that gets distributed, and I'm going to cover a little bit more details in a moment. But first, we'll just go over and just state that age limit for IRA contributions has been eliminated. And then 529 rules will now allow up to $10,000 in lifetime towards qualified student loan repayments. So anybody who has a 529 plan, those beneficiaries of that plan can now take up to $10,000 of that in their lifetime and apply it towards student loan as a qualified distribution. So again, talking about that 10-year rule, what is that? That's inherited IRAs, Roth IRAs, qualified plans. They all must be distributed within 10 years of death. There are exceptions to that. So surviving spouses, there will be no impact. It will still follow the same as it has been for years under what we call a stretch provision, which essentially means that you can distribute that over your lifetime. There's also exceptions with minor children, disabled and chronically ill, or individuals who are within 10 years of age of the IRA holder. These individuals are known as eligible designated beneficiaries, or EDBs, and essentially they will all follow that lifetime provision of distribution, not that 10-year rule. There's an exception with minor children. Once they reach the age majority or 18, then they actually have to distribute that within 10 years of turning 18. So let's take a look. We actually have kind of a comparison of what this looks like. So under our old rule, those IRAs, again, they allow to be stretched over that lifespan. So we would see a situation, what we would call a multi-generational IRA. So an IRA owner, let's say in this example, the spouse passes away, they leave that IRA to their surviving spouse, at which point they are able to distribute over their lifetime. And when that surviving spouse passes away and the child then inherits that IRA, they would still be able to distribute over their lifetime. Well, now that's gone away. And what I mean by that, again, we'll look at here, the new rule is that account must be completely distributed by the end of that 10th year. And that's following the year that the account owner dies. While it's eliminated the requirement for RMD distributions, now that IRA, once I inherit that IRA, I would need to distribute that by the end of that 10th year. So what are John and I really focusing on? What are our primary objectives with this? It's going to be the same. We're going to have that primary goal of managing taxes, minimizing that tax rate, minimizing that tax burden in the most efficient way possible, and then taking advantage of tax deferral for as long as possible. A caveat to this, there are certain beneficiaries that don't follow either of these rules. They actually follow a 5-year rule. So make sure that you talk with your tax advisor to truly evaluate your situation, what impact is for you. So let's take a look at an example. We're going to take Miss Sally here. She's 55 years old. She's a vice president at American Express. And Sally and her husband make a combined income each year of $275,000. Her and her husband expect to have that steady income over the next 10 years. So no substantial changes or variances in income. Sally receives an inherited IRA from her mother. And so now Sally has to fully distribute that IRA within 10 years. So John and I have actually looked at this. We've run some financial calculations, tried to determine, you read some white papers and tried to determine what would we do in this scenario. And the strategy in many cases is doing an equal distribution over that 10-year period. Now, again, we actually put a model around it. It's not just as simple as taking an even amount of that 500,000 over 10 years. We want to consider market growth in that qualified plan, forward project what that looks like. So it really does take some planning to ensure that we don't end up with an appreciated IRA at the 10th year, where Sally's been taken out, even steady Eddie, but then that last year there's a lump sum that's still left behind and can create a large tax impact. So John, I really want to make sure that there's a plan around that so that there's minimize that tax impact as much as possible. Let's look at a few other scenarios. So the first one we're going to look at is a scenario where we would want to do a lump sum distribution immediately. So if that amount, let's say it's a small amount, let's say the inheritor is in a low tax bracket and there's not going to be a substantial impact, it might make sense for us just to take that distribution immediately and then allow that to be able to grow, or maybe they just need to use those funds, whatever that looks like. It's not going to make much of an impact at all. An alternative, and this is where it gets kind of fun for John and I, because there might be a scenario where we have what's called gap years. So in this situation, we're going to have, let's say we have an individual who they're approaching retirement. They're not quite there yet. They're still working, still in a high tax bracket, but they know within the next 3 to 4 years that they are going to be stepping away from that income. But we are still a few years away from when we want to start kicking on Social Security, pensions, those items. Those are what we call, the in-between is what we call gap years. And so we've actually found that we can take advantage of those gap years, distribute those inherited IRA between those years where there is a low tax bracket, minimizing the tax impact during those years and supplementing that income. And then at which point that's fully distributed, in this case, between years 4 to 8, fully distribute that beneficiary IRA. And then we would have the ability to kick on that Social Security pension thereafter. And that's going to be the most efficient method for that. And then finally, just a flexible distribution, which could be as needed. So with that, what do I mean? So we have clients that have varying income. So some years are boom, some years are bust, and we know that this is a common pattern. So maybe we take advantage of the low income years and we distribute those and then slow it down a little bit in years that have high income. So we have a little bit more control. Also somebody who might be able to take advantage of a sabbatical. Their employer offers them the ability of unpaid leave to do various items. And well, now we can take advantage of this beneficiary IRA to supplement income during those years. So that is all I have to say on Secure Act right now. So John, I'll let you take us home.
Yeah. So just to wrap up, we want to thank you guys for being on the webinar, and hopefully we'll see everybody in person in a few months. Is one thing we really pride ourselves here is constant communication. And I referenced earlier how I remember when the market took such a big dump last year, and I remember just said, let's just call everybody, right? I'm not going to shy away from this. It's like this happens, and we made it through it fine, right? So constant communication, frequent discussions. I mean, we're kind of financial geeks here, so we're constantly reviewing income tax, estate planning, all these sort of things. So we like to keep this in front of you. So that's what, we're very consistent here. We pride ourselves in that. So we want to make sure you always hear it from us first, so to speak. And that's what we love doing, and we love doing for you guys. And Ariel, I'll turn it over to you.
Yeah, absolutely. So thank you everyone again for joining us. We're going to take a couple minutes. We do have a couple of questions that came in. So if you just want to stay on with us and get those questions answered, we're going to do that now. Otherwise, just want to say thank you really quickly. Again, we can't stress it enough. We're happy to be doing events like this, and we hopefully will be able to see everyone in person here shortly. By the end of the year, I think is very optimistic look. So we do have a question that came in, and the question is, there's a large amount of money the government is going to be pumping into the economy due to COVID. While it may be great now, I'm worried about the amount of debt to be paid off later. What's your take on this? Should we be worried about the economy in the future due to the amount of debt?
I'll jump on this and I'll let Jordan finish it off. So as I used to worry a lot about debt, but what I realized is the U.S., as long as the U.S. dollar is the currency of choice worldwide, as long as we can print money, I'm not too worried about it. Now, if I was all in fixed income, I might, but if you have a nice balanced portfolio that's got equities, so if we do have an inflationary environment, because that's what it would cause inflation, that you're riding that wave up because you've got some equities. And as long as the US dollar is here, I'm not as concerned about it. I think we're going to be fine. I think in 30 or 40 years, when we eventually the world goes off the US dollar, I think that's something that's going to have to get solved for. But like I've told people in person, that's when I'm going to turn over to Jordan to solve in 30 years. So he'll be solving that. So frankly, I'm not worried about it. But Jordan, I wanted you to jump on this answer as well.
Yeah. And obviously, it's something to be thinking of. It's absolutely something that we need to be concerned with. It's not a good thing, obviously, taking a huge amount of debt, but we have to keep in mind, these are funds that are being pumped and injected into places of the economy that really need that support. My own opinions aside, this is what our government is deciding right now, is really to stabilize and put as much as needed right now. And in the short run, that's going to kick things on. It's going to start generating GDP. It's going to start generating activity. But long term, that's still going to be there, and eventually it's going to have to be repaid. And how is that going to be done? Well, we already know with the Tax Cut and Jobs Act that's going to be sunsetting in 2026. We know taxes are going to be increased, at that time. And then we do see current administration looking to increase taxes in certain areas. So really, it looks like our extremely high net worth, I shouldn't say that, extremely high income earners, anybody over 400,000 and higher is going to take on a lot of that tax burden. But frankly, most Americans will not be impacted. So that, I guess, would be my answer to that.
Awesome. Anything to add, John?
No, I'll let that stand.
Perfect. Okay, we have one more question, and it's in regards to the Secure Act. So the question is, the Secure Act feels complex. We know. How can we rely on you as advisors to help us navigate around the Secure Act if it happens to apply to our situation?
Yeah, so this is something we're talking about. Actually, we're about to go into review season. We have several clients who are talking about this. That's one of the reasons why each year we request your income taxes, because we want to make sure we know what your income is, what your tax bracket is. So that helps us manage that. And then, as Jordan talked about earlier, what we sometimes want to do is actually do an income tax projection out a few years, so we know, hey, what's happening in the next 10 years? We can't always plan 2 years out, much less 10, but let's make an attempt at doing that. So I think that one thing, and it goes back to constant communication, one thing we do is we stay really in front of our clients during reviews once or twice a year, call rotations all the time. So we're always in front of our clients. We know what's going on. So that helps us make a better choice around what's going on in relation to their life, so we can help them with the Secure Act and navigate that for us. So we're definitely on top of that, and that's what we pride ourselves in. Jordan, do you want to add to that?
No, again, it just comes down to us really having dialogue, understanding the full picture, so that John and I can apply things that we're learning. We're constantly reading and sitting and listening and trying to understand this as much as possible so that we can apply it to our own clients' scenarios. So for us to be able to do that, we really have to understand what's going on. So that really is how we pair those two together.
Absolutely. Well, that is all the questions that we have. So I think we'll go ahead and let everyone get back to their Thursday night and jump off. Again, thank you everyone for joining us. We appreciate it. If you have any follow-up questions, anything comes to mind, please feel free to contact our team at any time. That's what we're here for. We want to make sure that we get your questions answered, or if you have any commentary from this webinar, we are happy to have you reach out and chat about it further. So thanks everyone. We hope to talk to you soon and see you, later this year in person, if not sooner.
Good night, everybody.
Have a good night. Thank you.